All right, ladies and gentlemen, wanted to show you this. This is just a great example for whether you are a futures trader, you trade the SPY, you trade zero DTEs, or even beyond zero DTEs. In other words, expirations beyond just today. Okay, so at 9:30, we got a trigger to go short a bear call spread. All right, another short at what time is it? 9:35, and then we got a trigger here at 9:45. You'd have felt some heat on this if you'd got in late on this one on the zero DTE. You could have got stopped out. Then there was another signal here at 10:37. But look at what happened. This was telling us before the futures market was giving us an indication. Remember, this is the dog that wags the tail. So it was giving us sell signals to go short. All right. Now remember, all this stuff is based on gamma levels and volatility, and that's what these are based on. So our zero DTE signals are based on volatility, variance risk premium, all right, IV, and we've put some filters in there, specifically VWAP and a different algo we use for the VIX. But just a great day there. Let's take a look at how that translated over into the futures market. Look at this, 9:30. We got the signal here. Now, our cycles did not give us a short, right? To be fair, to be clear, we were not getting shorts. We were actually still long. But take a look at here. When we started curving down, let's look at the standard deviation. Even here at 10:30, once we saw our Z-score break that zero line, we said, this thing's breaking down. So when you combine options activity and gamma levels, your variance risk premium, you combine, you have to look at these things in the aggregate. You can't just say, oh, here's the chart, here's what's going on. No, everything's interconnected. Everything is related. And if you pay attention to what's going on here, now remember, one of the greatest asset managers of all time, in my opinion, Ed Thorpe, he traded the S&P futures against the S&P cash at the time of the 1987 market crash. And so that's I don't want to say super common, but pretty common among institutions, a statistical arbitrage method. But there it is right there. Remember, I'll say it again. This is the dog that wags the tail. This is the tail. And take a look at what happened. Let's see what that move was. So it was a almost $1,500 move. Look up here. That was a $1,400. Now it's a two. That was a $1,500 move. All right. So now she looks like she's going lower. You go to the alert screen. You start looking. There she is. All right. Let's just go ahead and do this and update this and say, well, we're a little late, but just so you can see, we'll track this as well. 4 thunderbolts, or lightning bolts, whatever you want to call them. Okay, so we're going to go short the S&P at 75.90. Look, I'm not even thinking about it. This is a sim portfolio, but I want to see at 12:03. Let's take a look up here. 12:03, July 15th. We got a trigger signal to go short. So let's just take it to see how the behavior was. All right. Got a call coming in, but all right. So we're going to journal that. We're going to log it. Look at this open. Okay, so just so you're clear, this is SPX. This is the max loss. So it tracks the P&L as the max loss until it expires. But this is the unrealized loss. These are trades that we put in. What time? 11 o'clock. So we saw that late because the trigger came in and I wasn't in front of the screen. I saw it late. So it was a bear call spread. So the 75.75, 75.95. So that was a 20-point spread. A little bigger than some people like to trade, but that's what the indication was at the time. Let's take a look and see what happens there. But back to this. Now we have an open position. It's 12:04. We just took the 12:03. All right, we went short, and let's see how this plays out. All right, what did I trade? ES. When did I trade it? 12:03. Why did I trade it? Based on these lightning bolts or thunderbolts. So you can use thunder or lightning. Let's get back to this. We'll circle back to this to see how this trade worked out. We'll circle back later today to see how these zero DTEs worked out, if they expired worthless as we were expecting. And you could even close these now, right? If you wanted to, you could just take your credit Here you get credits between 395 and 460. All right, so you have an option if you're a zero DTE trader or a futures trader. Do I take my money off the table? No, I wouldn't take my money off the table now. This move could just be getting underway. And that's it, guys. Keep your eye on the why. What and why. Just so you know what we did here. Where is it? Here it is. 223, 224. What did we do? We went long the ES, short the NQ. That was part of a spread. And we saw that over here. We got an indication of the ES-NQ spread. And so we went long the ES, short the NQ, and look at the trade. Boom, beautiful, beautiful trade. How much is that up? So just that spread from yesterday, 930, 6,900, is that right? Yeah, almost $7,000. But to the right, there's a P&L. So almost $7,000 on that spread trade. Guys, if you're interested in learning how to use this spread trade, spread trading is, in my opinion, the most professional form of trading because it combines relative value with everything. And options trade, I mean, when you're trading zero DTEs or vertical spreads, you're trading spreads anyway. So if you're trading the Forex markets, you're trading spreads anyway. So you